end before time, but possibly we end on time so that you are back home to watch the match today. I know a lot of people told me, but we never knew that India is going to play today, no, as per the calendar. The placement, we didn't know that. That's why we always make sure that it doesn't clash with the preliminary stage. But I know a lot of people watching online as well as now will make sure that, because this topic is so interesting, you will feel bad if we do it before time actually. But as usual, let me have the privilege of it's always a pleasure to have you with us this evening, and also all the viewers watching this program here in person. If you have any questions, a couple of good events which is coming up next few days. The next event which is happening on 24th of June. Before that, 21st June. 21st June is tomorrow. Tomorrow is the World Yoga Day, and we are also doing it Yoga Day. We are doing it jointly with another organization. What is that? No, what is the health? With whom we are working jointly? Brahma Kumaris. Yes, sorry, my apologies. I slipped the name. Brahma Kumaris is happening tomorrow with a yoga session followed by a good breakfast there. We are doing it jointly there because they are very professional. They do it very well. That's why we thought we collaborate with them doing it. That invite has already been sent to you. If you get time, do join them. Brahma Kumaris is one organization and do a fantastic job, and a very, very passionate team. They'll be teaching you everything, how to keep your mind calm, meditation, yoga. Everything is packaged in the next 2 hours program followed by a breakfast there. Please join us. Then on 24th of June, we have another event, an exclusive event where 7 women leaders are going to be talking here on the same platform together on media and new trends, challenges and opportunities today. So they're all achievers in their own area. Some filmmaker, Lata Menon, you know them. Lata Rajagopal Kumar is again an author and consultant, media personality. Deepika Kumaravel is again a great personality. She reads regularly All India News and many things. So we have a very, very good lined up speaker. It's happening on 24th June at 6 o'clock in the evening, same place, same time. Please do come if you are free. Then if you're not there, you can watch it later too, no issues. 26th of June, again we thought we must do this all on mental mind management, because we strongly believe, we have seen, every day you see in the newspaper, there will be always some news on the mental issues which the people undergo. And all the time it's been clearly proved that there's no proper communication between the mind and the body actually. The moment that mind and body communication breaks down, then we are in trouble. Then we don't know whom to give the leverage, whether the mind takes over or body takes over. Ultimately, mind takes over, we get into serious trouble and a lot of... So, to talk all about this, we are an expert, Buddhi Clinic. Buddhi Clinic is the one who do some phenomenal event. So, we're doing a series of talks on this and various subjects which are complex and which they make it simple and understand. With some practical experiences, practical choices which they'll be talking to you, and including ice-breaking sessions with you to make sure. This is one area, if you have a mental issues, many of us won't even know you have a mental issue. And I don't know how many of you, if you have a mental, I read in a newspaper a few days back, if you have some mental disturbance, it doesn't mean you're a mental. If you have some disturbance in your mind, you always get angry, you don't take decisions, you don't get sleep. Even students, when you have some pressure on you in terms of your performance in examination, your performance in the classroom, it impacts you. So if you have some small little tips, guidelines, you'll do extremely well. I've seen some of my friends are good world champions. Some of them are very good in, why? You take cricket team, no? How many mental coaches are there? Doesn't mean they are very mad or pagala. Everybody needs. Otherwise, when you go and talk to them, I remember we did a course on mind management, and one of the person went and fought with this HR head. No, sir, what do you think? I am a very mad guy. You are sending me for this course and all. No, we have to think. It's not that madness. It is to make you calm and make you. Please do come on this event. We have got Yadapatam Krishnamurti himself is coming and talking. We got Rudra Rao, Vivek, and Aisha, 3 experts from the area. We're talking on 3 different areas, so please do come. And the topic is unleashing the inner potential, cultivating mental resilience and well-being. So this is what is happening. Then 5th of July, mail must have already reached you. Our flagship event, MMA AGM award function, and the Management Excellence Seminar. We got some outstanding companies that are receiving the MMA award for Managerial Excellence. Manufacturing TVS Motors is coming. You already come and listen to the story of TVS Motors, outstanding company. In services sector, City has got the award. In education sector, in fact, in MSME sector, again, we got an outstanding company. You must come and listen to their, some Sairam Education Institute is also one of the awardees. They'll be making a seminar presentation on that, what made them win the award. In the evening, we have award function. We have a galaxy of phenomenal events embedded into the award function. We have Narendran, who is the chairman of Tata Steel, is the chief guest. Then I mentioned that we have also Josh, who is coming from Bangalore, going to be another keynote speaker. Good. Followed by, we have a very gala dinner. We'll have a good time. I can assure you that. Lock your diary. We already sent you the thing. Please only confirm registration so it's easy for us to do everything in a proper manner. Then on 18th of July, we have an event on securing the future of digital safe payments. We have got RBI regional head is coming. Besides that, we have got some outstanding speaker to come and speak on this quickly. Then again on Monday, 22nd July, success story Abuto was done. Because the printer who started with nothing and today is one of the finest thing, publishing thousands of books and Notion printers. You know, you must have met Naveen and also Bhargava. They are coming and sharing the story, how they are able to encourage so many young guys to do that. And luckily, MMA also publishing a book which will be launched on the day of, on MMA AGM day. MMA is publishing, and we are going to be publishing book as often as possible on various subjects. And having experienced this, I thought I telling my team, we are going to open a publication department. It's so simple, so easy. We have got all the wherewithal to do it actually. We are publishing a magazine every month. Why not we do that actually? So we are already business plan is on to do that. Every member want to publish it, please come to MMA. We'll publish your book. We'll make sure it's going to Amazon, going to international. We are doing it, the turning point management lesson from legends. Beautiful compilation of some of the best talks. We are doing it. We got some 1,000+ lectures. Everything 25, imagine 1,000. It will take a couple of years to reach. We will be doing that actually. So soon you will get to know from MMA that how to publish books actually. There are so many things happening. I can keep telling you. Then success story, then mental well-being. So actually we already finalized program till end of August. July we finish. Now coming to today's event. This is a program which eagerly looked at for by many of the participants every month. They're coming without fail for the last so many years. And we must give a big round of applause to the people who are driving this event. Babu, Sangeeta, and they are the people who run this program. Without fail, every month, getting some outstanding speakers, I can tell you, it's not an easy job. All the credit, everything goes to the team, led by Babu, Sangeeta, and they are the people who actually drive it actually. Gentlemen, put your hand together to welcome the distinguished panel for this evening. Babu Krishnamurthy, Chief Sherpa, Ajit, Gautam, partners in Chartered Accountant, and Satyanarayana. May I request you please take your place on the dais. Okay, sir. You're not read book? What does it mean coffee? What is coffee got to do with investing? It's very interesting theme, no? But it's got a lot of meaning. It's not, it's happened now. It's happened, they will talk more about it. It's from since 1980 onwards. It's one of the oldest concept. But you should know this, why this, not only will really help you in your investing and thing, it will help you in many decision making things. And let me have the privilege of introducing a distinguished panel for this evening. Babu Krishnamurthy is the founder, chief chef of Sherpa Investments, and he's a chartered accountant with over 25 years of financial and wealth management experience. He co-founded Pelican Wealth and worked in Algero Capital. The author of the speaker, Babu wrote Unlock Secrets Wealthy Life. He is also a Rotarian, past president of IFA Galaxy and Amateur Marathon. He's still current president of Rotary, yes, current president of Rotary. And I know he's a great Rotarian. I've seen him in action in Rotary. very passionate person, done some phenomenal work, and I see him more often in newspaper picture than in meeting once in a while here in the MMA, in the event. Welcome, Mr. Babu. Lovely, pleasure having you with us. We also have with us Ajit Gautam. Ajit Gautam, Chartered Accountant, a Cost Accountant with over 30 years of expertise in finance, accounts, business development, and planning, budgeting, long-term funding, and treasury management. He has a proven track record in business strategy, investors relationship, and negotiations, leveraging analytical skills to industry knowledge. Ajit specializes in business planning, deals evaluation, financial compliance, and client relationship management. Ajit, pleasure to have you with us. Very welcome to MMA. Other distinguished speaker for this evening is Mr. Satyanarayana. Satyanarayana is a seasoned professional with over 20 years of experience in banking, compliance, private banking. He holds a CFPCM and also EGMP and IIM Bangalore, and also advanced degree in commerce. As a partner of Krishna Capital, he is a AFMI registered mutual fund distributor. His career includes the senior role in DSP Merrill Lynch and Edelweiss Capital, a number of other international banks. Satyanarayana is an accomplished lecturer and member of the various professional associations. Ladies and gentlemen, you're going to have a feast of a time this evening. And as much as you, I'm also looking forward to listening to very, very thought-provoking discussion this evening, so that if you missed the bus, you can start catching the bus today. Over to you, Bob.
Thank you, Group Captain Vijay Kumar. Always inspiring to hear the number of activities that MMA does and the number of years continuously that MMA has been awarded the best management association in India. I think kudos to that. In fact, I feel like taking a breath now. You've been breathlessly speaking for quite a bit. So thank you so much. This is a passion, like Group Captain Vijay Kumar mentioned. This is a passion project for the three of us, Sangeeta, Ramprasad and myself, and I speak on their behalf as well. We got in with this project, I think, at the middle of COVID, and the driving passion for all of us is that readers are leaders, as we say, and the only way we can grow our intellect is by tapping into the thought process of others, and that's precisely why we took it up. Each of us do it once a month. So I'll quickly dive into the current book, which is Coffee Can Investing. The logic of the book, I just wanted to kind of say, 2016 was a epoch-making year in various sense. It was the year in which, if you remember, demonetization was announced. While we may have argued whether it worked or didn't work and so on and so forth, the one significant thing that happened after demonetization was that money from a physical currency moved into electronic currency significantly. And that led to a process of a digital way of managing. So you had UPI, you had apps that came in which you could use using your mobile phone. And what that led to is something that nobody could have imagined, is the interest in stock market. With one simple mobile phone, people sitting anywhere in the country could go in and buy even a single stock. And it made it so accessible that suddenly you had hordes and hordes of people entering stock market. As per the latest data, on a month-on-month basis, even currently as we speak, we have 1 million new investors entering stock markets to buy stocks. I think it's a fantastic phenomenon for the country in terms of the expansion of capital market to the rank and file. But also what is important is that while everybody is getting into buying stocks, I think one of the things that everybody needs to remember is, do we have a framework in mind when we do? Every task needs a framework. And that's where I thought this book, Coffee Can Investing, is a nice concept, because at the end, underlying, it provides a framework of how one can go into stocks and investing, and it touches upon various aspects. Written by some of the practitioners of the craft. So Saurabh Mukherjee currently runs a very successful a fund called Marcellus, which has been doing exceptionally well. But prior, he used to be with Ambit Capital, and he is actually educated in London. So he has a pedigree of equity investing, has the experience, along with Pranab and Rakshit, who have worked with him in Ambit. The three of them have been conspirators, so to say, in the development of this book. So that said, I think this book, like I mentioned, is a must-read for somebody who is trying to make a long-term future for themselves by investing in stock markets. Now, I just want to give you a heads up that there may be multiple philosophies of making money, right? You could have a trading philosophy, which means you buy and sell constantly with the idea of making money. There is another philosophy of investing, which is long-term. You buy and hold long-term and then make returns. This book is all about doing enough homework so that you buy and hold and make money. So it's not a trading strategy. It's not something. It's a very simple, easy to use book. So I'm going to pause here. Enough of listening to me, and I'm going to bring Ajit in and get his viewpoints initially on what he thinks of this book. Over to you, Ajit.
Hi. Good evening to one and all present here. Special thanks to MMA Mr. Vijay Kumar for having this month on month. And thanks to Babu for inviting me here. I keep thinking, why did, over the last 1 month after Babu told me, this book, read this book and can you do a book review? I was just wondering why he chose me for this specific book. I've known Babu for 30 years, and in this book there are two fictional characters. A Talwar and a Sanvi. One of both, I'm 54 years and both my age, both who graduated in 1990, one in employment and one in business, who made some wrong decisions on their investment portfolio. I then thought he probably invited me because he knew that I had made similar wrong investments as well. I had half my career as a working professional and half on my own. And I probably I'm a mix of both Talwar and Sanvi. And the decisions you make are independent of whether you're in employment or in business, but it sort of represents what people who have typically got into an earning cycle in the 90s, what they could have done wrong and what they should have actually done. Okay, so this book heading, the coffee can investing, after reading it twice, I actually think that name, okay, though there is a logic, there's a coffee can portfolio which is talked about in this book, I think the name is more to capture attention. Okay, so you can actually say, why should you put money into financial instruments and move away from real estate? Nobody would have probably bought that book. You would have needed hundreds of book reviews to actually make someone read this book. So I think catching the attention is the coffee can portfolio. There is a meaning to that which is explained. But the primary objective of the book is to say, hey guys, if you have had money, if you have an investment portfolio, unlike what a typical Indian has done in the past, which is investing in real estate, 77%. See, this book was written in August 2017, so slightly outdated in terms of what the current developments of the last 7 years. But when it was written, 77% of household savings was in real estate assets. Okay, so this book actually talks about what people should do, why they should move away from real estate assets to financial instruments. Okay, so it explains in detail with illustrations, graphs, and with the support of Ambit Capital's research team on what should be done. Coffee can is one of the portfolios which, as per the recommendation we say, is you need to have 20% in coffee can portfolios. What is it? We'll come to later. But Saurabh and his team are also recommending why you should have a part of the portfolio in large cap, exchange traded funds, small cap funds, clean and good companies. So he's saying there may be a lot of companies which may fall into different buckets as it's defined. We'll come to that later. He says also invest in clean and good companies. Okay, irrespective of whether they are large cap, small cap, whether they are fit into the portfolio of coffee can. invest in clean companies, invest in good companies. So invest in companies which have shown good growth and which are also transparent and which the world likes in terms of cleanliness. Because there is a bit of mirth around Indian companies and the occasional scams and others which happen. So the book goes about in detail on why you should invest in certain categories of investments, why within that financial instruments itself you should have a diversification, and it justifies why you should put money into various portfolios of different categories of mutual funds, ETFs, coffee can portfolios, and so on. So it's a very organized book. It clearly says you need to move away from real estate investments. It's given a degrowth over so many years, and it's probably that cycle is not yet over because the Indian residential and commercial market is overheated. It may take a few more years for it to correct. And why you should be part of the world of financial instruments in a significantly more, in a better way. So that's what I liked about this book, and it just doesn't say something without explaining why. There are a lot of detail, a lot of graphs, illustrations, and information available over the last 25 years. So the data is primarily from 91, when post-liberalization, and it is there till 2015-16, so 25 years. So a lot of data has gone into how you should actively involve in research before investing and then stay invested. Don't worry about what's happening in the market today, yesterday. NDA comes, goes, exit polls, doesn't matter. You don't have to look into it. You're invested in a good stock, stay invested. It will give you returns over the long term. That's the message from the book in a nutshell. Thank you.
Thank you, Ajit. That's a great way to start. Satya, your initial thoughts on the book. Yeah, you can speak.
Thank you very much, Team MMA, for giving the opportunity. Thank you, MMA, and also Babu Krishnamurthy for giving this nice opportunity to deliver, what is useful for the group. That is the main purpose, and Babu and MMA trying their best to, make the people to read. That is the first message. Okay, maybe if you are not reading, you have to read. That is first message. And what is the outcome we are going to get actually? 100% once we started to read, the outcome 100% will be there. Whether for you or for us, it will be there 100%. And if you get into the coffee can portfolio, the message is very loud and clear. Very loud and clear. Be with the quality. That is the first message what he is talking. Irrespective of the market cycles, the quality will perform. The quality, corporate governance, these things will perform. Probably, maybe as Ajit said, somebody will come and go in the politics or maybe in the policies. Things will keep changing only. But if you are sitting with the quality companies, with the corporate governance, no need to worry much. Maybe only nobody knows the right time. You have to buy properly. That's it, I will say. Not right time. Nobody knows the right time. And the second thing, one thing alarming actually, Babu mentioned actually, every month some million new people are joining because now for the last it's the longest bull run what we have seen. And we have to be little bit concerned and we have to be cautious. That's very important. Because we have seen from 2004 to 2007, the bull run we have seen. Now from 2020 to 2024, again the bull run. There is no need to be worry and all, but we have to be very much disciplined. That is very, very important. So read and grow. First we have to read. Like mutual fund we say, before you invest, please read the offer document. Same thing, before you are getting into equity, you should know the promoters, you should know the quality of the company and also what they produce and what they are going to give back to us. Because everything is notional until you sell. But notionally, definitely we will enjoy. Like maybe my father bought for 10 lakh rupee, it would be the property could be worth for 1 crore, maybe after X period. But the same thing here also. Somebody bought something, you have to wait for a longer duration. Tamil elarku theriyum nenikren. Just I will say one small Tirukural here that is very much practical. Kalam karudi irupar, kalangadu, nyalam karudubar. Just it is for the war actually. Whenever they go for the war, they will wait for which is the right time. And the same thing is applicable for investments also. Very much it is applicable. And that is the message what I am getting from the book, first message. And as Mr. Ajit correctly mentioned, that maybe it is 2017 to 2024, 7 years, many changes happened. But the ratios will be the same ratios. Whatever he's talking about, price earning ratio or EPS or PEG, all same only. The numbers will different. And also 15 years before, if you are talking about forward 16 for India, developed economy could be, forward will be 12. But now America is expensive than India, but still we are, feeling, which is safer. That is the main thing. That's the message.
Thank you, Satya. So just going on, this book has been defined into 8 chapters, and which talks about, like Ajit said, it starts with the story of Talwar and Singhvi, 2 individuals, and how they have gone about their life in certain assets and learned through their trial and error. But it also talks about what it takes to create this coffee can portfolio. And it's very interesting that he talks about certain filters. He talks about a filter that says you create a portfolio of anywhere between 10 and 25 stocks only. You don't have like 150 stocks. You can even buy 1 stock. But he says, do your homework and, kind of make sure that you don't have more than 10 to 25. That's the magic size he says you should have, because that's what you can monitor, that's what you can follow as well on an ongoing basis. Within this, reasonably diversify. And he talks about a concept of 5 filters. And he talks about size, he talks about moat, he talks about various other things. If you could pick up 2 of those criteria, Ajit, and tell us in your thought process why those are important, and if your own experience of companies that have done that, been there, done that.
Okay, for the investment portfolio, like Babu mentioned, there have been a lot of criteria which Saurabh and his team had taken. One is, first, it's a listed company with a market cap of not less than 100 crores. Okay, so that's a primary criteria. The company should have been in existence for 10 years. Okay, and in those 10 years, they should have grown year after year by not less than 10%. Okay. Now, part of the growth of a company will actually come from inflation. Okay. So he actually wanted to have a post-inflationary net of inflation growth, but then he found in the first year itself there were a lot of very few companies met this mark, and therefore he said, let's look at revenue growth of 10% and not 15. He wanted to start off with 15, but then he revised it to 10%. The revenue growth not compounded, but year after year of 10% for not less than 10 years. So so the coffee can portfolio, it was a research. So the first, like I said, all the research and data are for the post-liberalization period. So the first 10 years was for the companies between 1991 to 2001. How many companies as of 2001 had a market cap of 100 crores and a revenue growth year after year of 10%? So this was second criteria. Third criteria was they should have had, this is for companies which are not in the financial services sector. And the third criteria was they should have had a return on capital employed of 15%. Okay, so the logic for return on capital employed at 15% was a combination of, the risk-free rate is so much, the premium which anybody would want for investing in an equity portfolio, the beta, and the India's beta. So all of this was combined for him to arrive at a number of 15%. So he looked at companies which have had an ROCE of 15%, grown 10% year on year for 10 years. And then he constructed this portfolio on 2001 based on 10 years. So he did this similarly the team did this similarly for every 10 years. So if there was a portfolio constructed in 2002, it was for companies which had grown on 10% year after year and 15% ROC from 92 to 2002. So each year when he selects the portfolio, he goes back 10 years and then selects this portfolio based on these 2 criteria, main criteria. He had similar criteria for companies in the financial services sector. There it was a return on equity, not on capital employed, because financial services companies are typically borrow and then that's also part of their overall process. So it's return on equity of 15% and a growth in loan portfolio of at least 15% year on year. So this should have happened for 10 years for these companies to be part of the coffee can portfolio after 10 years. Okay, and then what he has done is, 10 years you need to have a history. And then he has evaluated for each of these 10 years, what were the returns from each portfolio of coffee can portfolios for the next 10 years. So when 2001 to 2011, they have actually calculated the returns on the portfolio of companies which actually met the criteria which they had established for CCP. And these were the minimum criteria. So will we get into the research now? Okay.
We want them to buy the book and read. Let's not get into specifics. Satya, the other, I think he spoke about brand and moat. If you could elaborate a bit on those criteria and if anything else on the criteria.
True. If you see, for example, the brand, whenever they're talking about the brand, normally when I was doing lectures also I will say, which one to buy the stock. Suppose if we say which one to buy, we will call some child at the home, tell them what he likes. Suppose what is the product they like, they will say Cadbury, they will say Nestle. They will not say something, which is unknown actually. So, as per the author, what he says, if they are getting into the brand is built over a period of time. It is not built with 2 years or 3 years or 4 years. So, over a period of time, brand is built. Once the brand is built, that becomes unshakable. Like I take, for example, Tata, brand Tata, which is not shakable. So, once the brand is there, automatically we will feel which is good to be getting there. So it is like a little bit fundamental analysis there. So that will help the investors to pick the right company there. So within that company, for example, which sector we have to get in. Suppose, for example, somebody is getting, without experience, something they are starting some companies, not to get in there. So if the brand is there, they want to keep the brand so that the company will do very well. Even some difficult time, we have seen Tata Teleservices, just I'm quoting the example. So whatever the stocks I'm mentioning here, being a mutual fund distributor, I have to say the disclaimer, whether I own the stocks or not. I may own or I may not own. Maybe mutual fund schemes, whatever, if we throw something end of the session, but it is not for sale or not to subscribe. And it is, everything is subject to market risk. So come to that brand, if you buy a particular company, where there is a decent brand or the good brand, definitely that management will not allow that brand to die because of that single company. So that is very, very important message. Suppose if you pick any individual company, just to see, there's a new company, maybe like 100 crore and before, what was talking about the market capitalization 10 years before, maybe there is a small cap company or a mid cap company. But today, as per the SEBI categorization, top 100 companies will be the large cap. What they are talking about, 3,000 to 6,000, 3,000. It varies from time to time. Before we are talking about more than 20,000 crore as the market capitalization is the large cap companies. Now everything changed. Top 100 company will be the large cap. That Sensex, it was like 75% was in large cap. Today it is only 63-64%. Rest is mid and small cap. So end of the day, which one you are buying? Whether you are buying a large cap or you are buying a mid cap, we are buying a small cap companies. But you have to be cautious when this large cap means that is already the brand is established. Suppose if any fund house, if you are taking, for example, any bigger fund house, they will monitor only 200 companies on an average. 200 companies will follow. Like, Grow and Rich, for example. Can I follow maybe Facebook, how many people you are having? Suppose 500, 1000. But how many close friends you are having? Maybe 5, 10. The same thing like coffee can portfolio also, if you see, focus on the minimal with the very good quality, not to miss the opportunity. That is the main message. And when you fall also, you will not get hurt. That is again the best message.
Thank you, Satya. I just want to add on, like Ajit said, so one of the things I loved about the book is the criteria is divided into numbers, like Ajit said. Is the company in the last 10 years has been growing revenue every year at the rate of 10%? And very, very good point he made is it's not a compounded 10%, which means you don't take from year beginning, year end, and then find out the compounding rate, and if it's 12%, it meets. It means every year the company must have grown. And in a 10-year period, I'm sure there would have been great difficulties for companies. The industry may have gone through difficulty. In spite of that, if the company has been able to do a 10% jump in revenues, then it really speaks volumes about its management. That's one. Second, talks about 15% return on capital employed. You know, you put your money in the bank, you're getting 8-9%. So why would you run a business if you're not able to get even 15% return year after year? So every year the business must have generated a 15% return. But these are financial numbers. He's also talked about non-financial. Like Satya mentioned, it must have a reasonably good brand. The brand must be recognizable by you in the field that we talk about. Third, last, it must have some competitive advantage, or what we call in the financial services space as a moat. Right? Very close to this place, we have a company that's called Sundaram Finance. Right? I'm just taking this as an example. Please do not take this as a real life case. This is not quoted by the author. Now, you may have enough money today to start a Sundaram Finance equivalent today. But to get to where Sundaram Finance is, it will take you another 50, 60, 100 years. Because it's not just about the money. It's about the trust. It's about the network. It's about those 700, 800 offices in every small city, town, village that they have. They have a representative who knows how to finance trucks, who knows the truck owner, who knows the truck owner's family, who knows everything about that. That information, that knowledge is intangible. That part of it, for you to replicate, is difficult. That's what he means by the moat. And every business has a moat. And it's important to then understand what that moat is. Therefore, he says, look at financial is good, important, but also marry it with the non-financial aspects like the moat, which is very difficult for people. Because this moat means that your business is not easily threatened by a new player. So that's interesting. So he's given a framework of how you should choose your stock portfolio and create it. And of course, the good part is, he says, once you invest, like Ajit said, stay with it for 10 years or 15 years or 20 years. As long as the stock is on its way, just continue to hold on. So it's really the long term. But I'm going to come back to Satya quickly. One of the points he mentioned, Satya, and since both of us are in the investment distribution space, and this is very relevant to us, is he says expenses and costs are something that kind of needs to be watched out in whatever you do. Right? Whether you're investing in a mutual fund or whether you're investing in a stock, there are costs attached to it, and many a time the costs are hidden. Right? So he says you have to be cognizant of the cost, and if you're able to marry a low cost with high performance, which is what this book is all about, the low cost route to stupendous wealth, then that's where the magic happens. My question to you is, there is, in the mutual fund space, there is this direct, which is DIY form of mutual fund investing, and there is a regular investing where there's a distributor like you and me who kind of advise. While the direct is cheaper relatively, there is a costlier version here. And the book alludes to the fact that the cheaper version will save you a lot more money in the long run, right? So I want, since you're a practitioner of the craft, I'm putting a difficult question to you, is how would you defend your position? And plus, what are the criteria people should differentiate when they are going from direct to regular or from regular to direct?
What the author speaks here about the cost involved in buying and selling the stocks. That's the first thing what he says. And if you are keeping the advisor, like a registered investment advisor by the SEBI, you may pay some fees like how you pay to the doctors or to the lawyers, the same way you will pay to the advisors. If you are buying the stock directly, there is only one-time expense involved. That is a commission what you pay. Maybe 0.5%, 0.25%, maybe like 0. I'm not talking any companies, not to sell anything here. Just I'm quoting because of what is happening now. 20 rupees per trade, or maybe only for buying. Even 1 year free now. TV showing 6 months no charges at all. If you open the account with us until December 31st. Free is a dangerous word. It is a very, very dangerous word. Vijayakant Tamil சொல்றாரு மன்னிப்பு அப்படின. Same thing, free is very dangerous. If you are getting like combo also, that is also again dangerous. Youngsters are here. Just I want to say, if anything combo we love to buy actually. And better to, in normally when we say, if you avoid the wastages, you can be a crorepati. At the age of 20, if you realize, if you are avoiding the wastages, I am not telling you have to save. The wastages will become like 2 months before I addressed chartered accountants for the financial liberation, waste to wealth. Now, just by saving the waste, we become crorepati. Another one step here, what Babu is asking us, whether to go direct or regular. In mutual fund, there are 2 platforms available. One you can buy directly, which was introduced 5-6 years before. Where the expense ratio could be 1%, just I'm telling approximately. Maybe it differs from scheme to scheme, category to category differs. For example, I'm telling you, if the equity fund will charge you 1% for direct and 2% for the regular platform. Suppose if you are coming to any like distributor, mutual fund distributor there, they will charge you 2%. If you are going directly and buying from the asset management companies, it is only 1%. Suppose, assume you are going to put 10 lakh rupee. Every year, your expenses only 10,000 rupees. On incremental basis, if the asset is increasing, you will pay on incremental. If you are going through any distributor, you will pay 2%. 20,000 every year you pay. Maybe this year asset is 10 lakh, you pay 20,000. Next year asset is 5 lakh. On 5 lakh you pay 2%. If it becomes 40 lakh, you pay on 40 lakh. That is what exponentially in compounded basis. Wealth is growing, you are also growing. Ethical people are expensive in the world. They are not cheap. If somebody is ethical, whether it's a doctor may charge you 2,000, 3,000, maybe he will tell you no operations or surgery. But he will charge you 2,000 rupees or 3,000 rupees. The same thing applicable for the lawyers, same thing applicable for any profession. Because nothing comes free. If it is registered investment advisors started in 2013, now we are almost 11 years. Less than 2,000 people are there. Less than 2,000 where the population is 140 crores. The reason, what is the reason? India is not yet matured market. That's what I was telling in SEBI forum also. Whenever we talk to them, I tell them, the India is not yet a matured market. It is a long way to go. Because market is, from 60,000 in 2021, just in 3 years we are at 76,000, 77,000. In the bull run, இப்போ டாக்டருக்கு இப்படி வயிற்று வலினா வீட்டில் 10 மாத்திரை சொல்லுவாங்க. இப்போ ஸ்டாக் வாங்குறதுக்கு everybody will say, yes or no? Everybody will tell you, go to any shop, they will tell you which stock to buy. That is dangerous. Suppose if you are going to the direct platform, if you know, Babu quoted nicely, do it yourself. So if you do it yourself, if you know the people, or you know you are within the family, you can do it, then that is the best option. For that you should know, read and grow. First you have to read what is the company, you have to spend time on that. This is the company I want to invest and I want to be part of it. So the journey will be there. Then definitely you will make that 1% compounding for next X number of years. But assume the capital market, how many people are, created wealth within this all. Created means I made some 12% per annum. We can question that end of the day. But really, how many people are successful? The managing the behavior only you are paying to the advisor. That is very important than, which is the right company. If you buy Nifty on your own, you will make money. Even the Nifty will be, 0.05% what you pay. If you are buying directly Nifty, you will make. Whether to buy or not, somebody has to tell you. Whether to hold or not, somebody has to tell you. Whether to sell or not, somebody has to tell you. If you manage your behavior, definitely you will make money more than buying and selling. Another thing I will tell you, the 5-star ratings normally are mutual funds. They will say the 5-star ratings. Maybe if you take last 15, 20 years, maybe you take top 10. I'm not telling top 5 or top 1. Take the top 10. You stick to only the bottom 10. Whatever you bought, like the bottom 10, you are not pinching on top 5. Let it 5-star rating. I bought this year 5-star, next year moving to another 5-star. Again I sell, I will third year I move to another 5-star. 100% they made lesser than picking the 10th fund and holding on to it. That is the first message. Because the cost is involved is very big, like 0.5% or 1%. Asim, I will quote for example, Parag Parek Flexi Cap. The direct platform will charge you 0.9 or 1%. The regular platform will charge you 1.4 or 1.5. The difference is 0.6. If you are ready to pay that 0.6 or 0.7, that is the difference what you are losing. And if you are getting an ethical person, trusted person, he will be with you for your life. That is the message. Because they can't say, because if you are getting into any person, trusted person for a long term, the good, nalla doctor power, nalla lawyer. Nalla lawyer means no, there is an ethical guy. That is something different. The intention is supposed to be very good. Intention, suppose somebody says something, you buy. Suppose if I say something, you buy. My intent is supposed to be good. The market may behave rationally, irrationally. That is totally different. Suppose if you get a right person, trusted person, paying that 0.7 or 1%, which is ignorable. That is message. I can do on my own, then do it yourself. Whether you are creating wealth. So if I will tell you, suppose somebody will tell you, Nifty is cheaper. Last 5 years, they are telling 80% of the large cap funds are underperforming the Nifty. That is what we can read it in the paper also. Somebody 93, somebody bought Nifty, maybe invested 1 lakh rupee. That time it was 770 or 800 Nifty. Today Nifty is 23,000. That 1 lakh has become 23, 24 lakhs or 25 lakhs. Suppose if they bought any flexi cap fund, any large cap fund, today could be much more than that. Maybe 100 times, maybe 120 times, 130 times. But that is extra alpha, what he was talking about, beta also. How much it is falling, how much it is going up. Maybe the Nifty falls 1%, the active folio will that portfolio should fall less than 1. That is the beta what we talk. Suppose if it falls more than that, what is the risk we have taken? All these things, your personal, trusted person, I will not call as a distributor or advisor, is the person who is going to help you. If you feel that person is capable or eligible to receive the difference, then you have to go with the advisor.
Great. Ajit, you have anything to add quickly? We need quick answers. And also I want to ask you about, can you elaborate on the topic which he spoke about? You know, all of us love real estate, but actually the author says real estate is a trap. So please help.
Okay. Just to talk a bit on expenses, I'll give an example which has been quoted in the book. Okay, you all need to observe this carefully. It talks about a 20-year-old. Okay, and I just want to add on to that. Talks about a 20-year-old. If he invested 1 lakh in a mutual fund which gave 15% returns year on year, there are two mutual funds for comparison. One which has an expense factor of 2.5% and a second mutual fund which has an expense of 0.1%. So the first is more of an active fund where there's more of distributor commission and expenses. The second one is probably more of a passive fund, which is at 0.1%. Okay, the example quoted in the book is, if you had invested 1 lakh at age 20 into the first mutual fund which had 0.1% expense year on year, at age 60, you will get a return of 2.58 crores. Okay? The second mutual fund, return on the mutual funds is still earning 15%, but it has an expense of 2.5% per annum. 1 lakh invested at age 20, the individual will get 1.11 crore at age 60. So what the book is what he's trying to say is, just like returns compound, expenses also compound. And most investors are not aware of the extent to which expenses compound. And that's why over a period of time, as it's happened in the US and India also, more of the funds have started moving into being passive funds. Exchange traded funds are an example. Less distributor driven. and more advisor driven, because the power of expenses tends to bring down the returns substantially over time, and therefore, as the market matures, the mutual fund market, more money is pouring into passive funds. There are more direct applications for new mutual funds, and how the expenses of running a fund or managing a fund has come down, increasing the returns to the investor. Don't look at gross returns. Look at net returns is one of the messages coming out from this book. So that's on the expenses part. On real estate, see, the real estate story in India goes before 1991, okay? So, people were just investing into gold, real estate, fixed deposits, and land, real estate, okay? So, it was a very, in a sense, unregulated market, and there were a lot of black money in the system, which was just there had to be a place where black money had to go. And that invariably went into real estate. Okay. And in 2005, when there was a little bit, there was dematerialization of shares. See, I'm quoting as per the book. Okay. So there was this thing that more money moved back into real estate. So real estate saw a boom between 2003 and 13. And that boom was, he calls it, it's actually a boom from if you hold real estate, but he actually calls it overpricing and a lot of other things. See, Saurabh has actually written this book to say why we need to move from real estate to financial instruments, how these give a return. So there is probably a little bit of bias, but all this bias is also backed up by data. So the prices of residential and commercial real estate during that period, 2003 to 2013, went up so much that it has, even though there's been a correction after that, he feels that the correction is still not up to the levels of comparison of prices. There are various ratios which he has used to explain why the market, even now, even though it's not grown in the last 10 years, is still not fully corrected to the levels of what it is in the rest of the world. Okay, and therefore, real estate market is still due for more correction, or probably a period when there's no appreciation, yields will be low, and therefore it doesn't justify in the short term to stay invested in real estate or to make an investment into real estate. Okay, so that's the message which is coming out in the book, and it's all borne out by data and over the last 15 years.
But I'd like to just kind of point out, like both of you have mentioned, is that since the book was made in 2017, and problem with many of these books which are data dense is that the data stops there. So between real estate and equity, if 2017 the odds favored equity markets, that time I'm guessing that the Sensex was some 25,000 or thereabouts. Today at 77,000 at Sensex, the same analysis could look very different. So the point which I'm trying to make is that don't take this as a gospel truth that equity is any day better than real estate. That's not true. I think what Saurabh is trying to do is two things. One is, equity as an asset is an easier asset to hold. You can buy an equity share with 500 rupees in your bank. You cannot buy a meaningful real estate unless you have a couple of lakhs. So from that extent, it's an easier asset to buy. To unwind an equity share today, it's 2 days. So if you sell today before the market closes, tomorrow evening there is money in your bank account. Real estate, if you set your mind to sell, it could be a couple of months before you realize. So there are inherent structural differences between real estate and equity. So Saurabh is merely trying to highlight that equity is a easier asset class and has historically, as of 2017, also done better. So why would you want to continue to keep your equity assets? And given that, like Ajit said, traditionally Indians have had 77% of their money in equity, he says the time is now to move from real estate to equity. Sorry. So that's the message. I'm going to dive straight back to Satya. He's been things. So another 7 minutes is there. So we will quickly wrap this up. Quick 2 minutes, Satya. Warren Buffett says investing is simple but not easy. And it's a beautiful phrase that brings out the essence of equity market investing. And Saurav Mukherjee talks briefly about that. And he talks about inherently the factor of patience and how behavior of an investor is a big factor in creating wealth. Can you elaborate a little bit on that?
I will give a small example. In Velachery, the flood has come. When the flood came, how many people sold the property? We have seen tsunami, Besantnagar people are living. How many people sold the land in Besantnagar? We will hold it, even irrespective of the problem, we will hold that asset class. But when it is coming to the capital market, we lose the patience. So here also we have to hold it. Here we will see a number of things, maybe some political changes or promoters suffering something, the stock prices will go up and down. But the same thing when the flood came or tsunami came, same thing is happening. But any given point of time when I want to sell my property, maybe the market price is 5 crore, maybe I cannot sell for 5 crore. That is a market price. If I want the money within a month, probably I get 3 crore or 4 crores only. So I am ready to see 20-25% loss in real estate at any point of time, and I will be patient there. But when it is coming to the capital market, if my portfolio is 10% down, 5% down, we will be worried because we are seeing it regularly. That what Warren Buffett said, but deferring the taxes. Deferring the taxes means I want to pay the taxes when I sell. That means I have to be patient enough to wait at least for 1 year in India. Not every, like in Saukarpat they say, what is a short term, buying at 10 o'clock, selling at 10:15. Long term, buying at 10 o'clock, selling at 3:30. So that's what they say. So it person to person differs what is a long term and short term. Warren Buffett says, for next 10 years, if the market is closed, I will be happy. So we should have that type of mindset, the same thing what he says, buy the quality, hold it with the patience, because you bought the best only. So you have to hold it to enjoy the return. Like I was talking about real estate, the lowest, what is this, India is giving the lowest 2% or 1.8% yield, rental yield. That's what he's quoting, because prices drastically went up. Like, especially the middle income, they bought the property on EMI last 15 years, they are paying EMI only. They could not do anything other than that. We have seen the COVID time, people lost employment. So they can't diversify, put it in the equity. Who is enjoying the equity? Again, the rich people. But the poor people or the normal people coming and going, no, they are not investing. If the life of the SIP, those who are having 5 years and above, is less than 2%. That is the patience for you.
Thank you, Satya. We have completely run out of time. I think a lot of questions also have come, so I'm going to get the panelists' final views on what's your summary essence of the book. Then we can go into questions.
Okay. To anybody here in this room who has money to invest and needs to know where to invest, I think you have to buy this book, read it not once, twice, just to have a grasp of the options available and why you are choosing an option, because it comes with a lot of data and analysis. Okay. Again, like Babu said, this is a slightly outdated book for 7 years. It would be great if Saurabh and team can come out with an updated version, because technically it can be a hot seller. I think a lot of what they have said based on 25 years, 1991 to 2017, will still hold good. But like we all know, when we keep reading, we know a lot of things have changed in the last 7 years. Money is poured into the stock markets. We have 60 lakh crores of assets under management, whereas as per this book, the last number which is quoted in 17 is something like 16 lakh crores. So it's increased 4 times. The market has gone up 3 times. Real estate prices are probably stagnated. So a lot of it may be true, but it's good to understand the basics of what has been the returns of the 4 or 5 categories of typical investments which an Indian makes, and then look at returns and see whether all the data which is there, how it applies, apply to each one's specific goals and see where they stand and look at what they need to churn the portfolio to get a higher return. Okay, it may be very difficult for somebody who has not got income now to look at the portfolio differently. But even then he's saying there's nothing wrong in churning a portfolio to give a high return. And there are a lot of myths about investing into various portfolios and various asset categories. He sort of says why these myths have continued to stay, and he sorts of rebuffs these myths and says underlying, end of the day, a stock market is reflective of an individual company's performance. An individual company's performance cannot be over a period of time very different from the stock market returns. So make analysis of companies, do detailed research. See, Coffee Can, just to clarify, he's not that he's saying everybody should put their money into Coffee Can portfolios based on the criteria. His recommendations to two of those characters is only make a small investment into a Coffee Can portfolio. Well-researched companies which have delivered based on the criteria which I mentioned. But he's not saying put all the money. He's still saying put money into ETFs, put money into small cap funds. He's actually saying look at companies which are good and clean. Okay. I can immediately think of Infosys. Good and clean companies. Put money, he's saying allocating 25% to good and clean companies. Now, obviously, good and clean companies or companies which meet Coffee Can portfolios criteria have to be researched. So, one of the underlying things is do a lot of research, invest into quality stocks, and once you have done that research, invest into portfolios which have 12 to 15 stocks like what Babu mentioned, and simply forget about it. Okay, it will deliver returns, and that book is all about analysis of how returns are being delivered by each Coffee Can portfolio. Okay, names of companies are mentioned in saying every case Coffee Can portfolio has delivered more than the Sensex. So therefore, there will be one or two stocks which may not deliver. Don't worry about those stocks. Stay invested in a portfolio which has all these 12. You will get better returns than what the market is delivered. The alpha for investing, the additional returns of investing in a Coffee Can portfolio will be much more than the index. That's the message which is also coming out from this book. Thank you.
Thank you, Ajit. Satya, your widening remarks.
It is actually what he talked about, patience. That's a very important. 10 years is minimum period, he says 10 years, less number of stocks so that you can monitor them. That's very important message what he says. And he gives beautifully some examples, two people examples he gives. And their portfolio also he gives, what they did, how they invested, and what is the course of action. In a very simple way he explained it. And which is the other side actually, probably it is outdated. Like for example, those days no taxation, now we have the taxation. Like a bond fund, the indexations were available, but they quote the indexation. Now the indexation is not available. And before 2018, we did not have long-term capital gain tax. We have capital gain tax. These things should be considered.
Sure. Thank you. Thank you, Satya. So we completely run out of time. With all your this thing, I'm going to quickly move into the questions. So I'm going to alternate between both of you. Ajit, the first rapid fire question. You have 60 seconds only to answer each of these questions. How does long-term investing as advocated by the Coffee Can investing impact a company's treasury management and liquidity planning? This question comes from Shweta, Chennai. Yeah, go ahead.
Which company?
How does long-term investing as advocated impact a company's treasury management? So,
which is the company? The invest?
No, she's asking this. Does the Coffee Can investing philosophy impact companies which manage their thing? No, I don't.
No, I don't think so, because the company is into running its business. It has its own treasury management for managing its operations. Unless it's a company which is into stock market investment, I don't think this question will apply.
Yeah.
But when it comes to a company which is fully into managing a portfolio of companies, Coffee Can portfolio will be very much part of their plans, what they need to do.
Thank you, Ajit. Satya, a question to you from Shakti Ambatur. What is your outlook on the future of Coffee Can investing? How do you see it evolving in the next decade?
The Coffee Can investing is a model. Suppose everybody will have their own model, and coffee can investing is also a model. If we follow like, company is growing at 10%, for example, EPS is growing at 10%, if the stock price of historically, if you see the stock price will also grow at 10 or 10 of plus or minus only. It will not be like, company is growing at 10%, stock price will be growing in a negative way. But always if you see a longer duration, 10, 15, 20 years, the stock price and earnings will go together only. Maybe sometimes because of the volatility of the market, because of the movements are irrational in the market behavior, sometimes you will see that is a very short period only. But in the longer duration, earnings and stock price will be together only. So that is a very important message. If you are buying a company where it gives you 15% in financial services, if you are buying 10% in non-financial companies, your stock will also deliver closer to that only, always.
Thank you, Satya. Pranav from Sri City wants to know what analytical tools or models do you recommend for evaluating companies to fit into the coffee can portfolio?
I'll leave it to Satya to answer that, more on the analytical side.
Here actually he is not talking about anything technical here. He speaks only about the fundamental. The fundamental he talks about the ratio analysis, all those things, the basic price earning ratios. If it is if you want to go for the technical way, then only all the different things are coming models. When it is a fundamental, you will go with the price to book value, price earnings ratio, and he talks about the PEG, the price earning growth also. That means PE divided by the earnings growth. So that is one of the main element he is pushing there. If it is less than 1, that is attractive.
Absolutely. Satya, one question coming to you, because he deflected that question. This question naturally comes to you. This is from Anish of Atur. How does coffee can investing align with the needs and expectation of high net worth clients in private banking?
It's a coffee can investing is a PMS, portfolio management services. We have seen a number of PMSs since 2004, I can say. I came to India in 2004. Every other people are now starting the PMS. But what we have to be very, very careful, whether it is a coffee can investing or whoever starts, like a Franklin or DSP, whoever it is it suitable for me? If I feel it is suitable for me, it is a long term, we have to get into investments. Whether it is a coffee can investing model or any other model. Maybe somebody will talk about 12% growth. Somebody will talk about only the growth style or the value style. He talks here, most of the time he talks about the growth only. Whether it is growing at 10%. If you believe, I want to follow only the growth way of the portfolio, then you have to get into the coffee can style of the portfolio. And definitely it will fit any style, whether it is value or growth, will fit into the HNI portfolio. Whether you are, assume today I am following the value portfolio like HDFC mutual fund or Franklin Templeton or ICICI value fund, they are not performing like 3-4 years before. But if you see last 3-4 years they are performing. So definitely it will be the part of the portfolio of the HNIs, whether they follow the growth strategy or value strategy. But here mostly what I have seen is following the growth strategy.
Thank you, Satya. Ashwin from Chengalpet has this question. Can you elaborate on the core principles of coffee can investing and why they are effective for long-term wealth creation?
I thought I spoke about this. Do I repeat? Core principles. Okay, core principles is do your research, invest into companies which have shown growth and return on capital employed for 10 years, and then do your research, and then invest, and stay invested for a period of 10 years, because the data in this book clearly shows that returns are over a longer period of time, not 1 year, 3 years, 5 years, but 10 years and more, are substantially higher than returns over the short period. And therefore, there is no great benefit in churning the portfolio. Even if you find that the market is overvalued and you probably need to exit, there is data given which says that you don't need to do that for a coffee can portfolio. Stay invested. Stay invested for 10 years or more. You will clearly get alpha or returns much higher than the index if you stay invested in these researched, analyzed companies and stay invested for a long period of time. So that's the message on coffee can portfolio standalone.
Yep. Thank you, Ajit. Akash from Sri City, what are the key criteria used to select stocks for coffee can portfolio? How do they differ from other investment strategy? Akash, I think you didn't listen to the entire information. 5 criterions we spoke to. Minimum market capitalization should be above 100 crores. The year-on-year revenue for 10 years must be above 10%. The return on capital employed must be above 15%. The company must have a reasonably well-recognized brand, and it must also have preferably a good moat or a key differentiator, as we thought. These 5 criterions we had spoken about, I'm just reiterating this. How do they differ from other investments? There could, for every one coffee can portfolio, there could be another 999 different tea portfolio, Bonita portfolio, whatever, name it, right? So, idea is that as long as it works for you, and this has worked, and there is data to prove, he has written a book and we are aware of it. So, don't get into too much. Understand this framework of investing, and when it works for you, kindly do follow.
Babu, just to add on, the word coffee can has been coined by, forgot the name of the person, Kirby, where it was something where Americans before the advent of investment banks used to put their savings and valuables into a coffee can and keep it below their mattress and forget about it and use it only when required. So that's how the name coffee can came. It's not something which is, it's just a name given to a portfolio where you have your savings, invest, save it, forget about it, and then get your returns later. In the case of the typical coffee can of the Americans, I don't think the investments, the valuables would have multiplied, but the logic is invest with quality researched companies and stay invested for a long period of time.
Typical of the Americans, right? So, our grandmothers used to put money in the rice buckets so that someday when it is needed, they will pull it out. But these guys have written a book on that. So, Americans are always great for branding.
Every dabba of kitchen will have
some money in it, yeah. Satya, 2 quick questions. How do you balance short-term financial needs with long-term investment horizon required by coffee and investing portfolio? Supreet from Chennai wants to know.
Okay. Suppose if you are investing for your short-term needs in long-term assets, you will not make it. If you are investing for your long-term needs in short-term, that is okay. But whenever you are investing money, whether it is a long-term or short-term, you have to define. Suppose I need the money, like somebody says, I will double your assets in 3 years. Maybe it happened probably in the past. I don't know whether it will happen in the future. So you have to define what is the period of the long-term and short-term. Very, very important for the audience. He says about 10 years. He says clearly 10 years is a long-term or very, very long-term. I told you, 3 months could be the long-term for some people. 3 years could be the long-term. Here he says clearly 10 years. So if you feel less than 10 years will be the short-term. So even less than 10 years, 5 to 10 years, even if you are buying some balanced funds, you will make it. That's what I feel personally. But can you pick the stocks individually like coffee can portfolio? You can do that also. But it cannot be like less than 5 years.
Fair enough. Ajit, a quick question to you from Manav of Avadi. Can you share any real-life case studies or examples where coffee can investing has significantly benefited an individual? Saurabh Mukherjee has benefited because he's written a book and we bought the book, so he made money out of it. That I can tell you.
Okay, to be honest, I won't be able to share examples. It's just, see, this book is all data-driven, researched. So, and he has listed out the names of companies which form part of the 17 coffee can portfolios. So, if you have invested in those companies, you would have got those returns as he has said. Okay, so it's obviously coming out from the book. I don't have real-life examples.
That's one thing I wanted to add because very important. If you see the mutual funds return, you can see in the AMFI website what is the NAV point-to-point return. But in India, for the PMS, we don't have that, audited data. Audited data means, only whatever the company says, we have to believe in it. And there is no published data by the SEBI or AMFI. So that, we can't say, this fund is performed 20%, 25%. We can't say that.
Satya, this question is marked to you from Muruganandam Puru. Mukundan Puru, sorry, my bad. How do you educate and convince clients about benefits of long-term, low-risk approach of coffee can investing?
The coffee can investing is not a low risk, first thing. Because even mutual funds are subject to market risk. And as per the SEBI, even if you are buying a gold fund is high risk. Gold fund. If you are buying any diversified large cap or mid cap, small cap is very, very high risk. They talk it is 6th grade in the speedometer of the SEBI. So if I come to the equities, like, buying 15 stocks or 20 stocks in a direct investments, it is not a low risk. It is as per SEBI, it is a very high risk. That is number one. And will I make money? I will give a real estate example. Suppose somebody bought maybe in T Nagar for 50 lakhs in 95 or 97. A long term, maybe 25, 28 years, a long term. T Nagar could be 8 to 10 crores now, or 8 crore. Will I get 8 crores in 1 month? That I don't know. But maybe market value is 8 crore. But somebody invested in any diversified equity fund, because there is no data for last 20, 25 years in PMS. Every single fund is 80 to 100 times. So what is the risk now? That low risk you are talking. What is the risk now? Suppose if I sell the T Nagar land 8 crore, maybe I realize 7 crore or 8 crore. If the market is good. If the market is good here also I will raise 80 times. That 1 crore has become 80 crore, there 1 crore become 15 crores. If market falls 50%, like a subprime, we have seen the subprime. Again assume another subprime is coming. Touch wood, it should not come. Assume if it comes, still I will sell it for 50 crores. So that is the risk what you are talking. Yes, if you are asking me personally, buying a land is riskier, or buying a coffee can portfolio or any other portfolio for a longer term, this is less riskier than buying a land. That is my personal opinion. But as per the SEBI, everything is subject to market risk and everything is very high risk.
So I have one more line to add. I think one of the places he says, equity is high risk, low return if you make it for a year. And if you make it for 10 years, very same investment will be low risk, high return. So eventually the point is, if you pick something of great value, which is how you do it with the criteria that we mentioned, and then manage to hold on to it for 10 years and beyond, you will inevitably make money. That's what I think is the summary of what this whole book is about, if you were to say it in a line. With that, we have completely run out of time, so I'm going to kind of hand the session back to Group Captain Vijay Kumar.
But I request Mr. Vijay Kumar to give the best question. You can tell I want to do small.
I think that only Babu can decide, because
that's a difficult one. Actually, I asked some good questions also.
You can give that gift to MMA for organizing this unit.
Yeah, you can give the gift.
We can give to the next thing, because getting them online, tracking them is quite... If somebody from the audience asks a best question,
Why don't you ask one good question, audience?
Anybody from the audience? You're going to get a gift, you'll be a wealthy man to get a gift from Satya. Nobody?
What about it's not patient, like temperament. That is you don't need to be very knowledgeable, very intelligent. You just need a patience, temperament to be a reasonable common sense. Be good enough.
Good.
But the fact that you mentioned temperament is that the temperament comes out of controlling your emotion. Right? And that is, in some sense, encompasses patience. If you are able to curb your emotion and stay invested, I think
most people lose money because of lack of temperament.
See, what Saurabh talks in his book, he uses a word called noise. He says, ignore the noise around you. Time the market, exit, high valuations, ignore. Ignore the noise around you, stay invested. He uses the word noise regularly in the book.
Sir, post now, we are crossing time. I think they'll be available here for some more time for that. Maybe one last thing I want to know. I think somebody just texted me a message. You said about a timeline. Is there any timeline for the individual? For example, one of the senior citizen member thing. I'm 60 plus. Is there time to start coffee can investing now, or I don't know. There's no time limit. So
life expectancy is 85 and above now.
Lovely.
20 years is a long duration.
Yeah. Your question is answered, sir. 85, so you're only 60. Not to worry, do that. Ladies and gentlemen, a big round of applause to Satya, Babu and Ajit. I think many of you are watching this program who are going to be, become more wiser. I don't think I would have got this advice maybe 25 years back. I'll be a really multiple crorepati as for Satya. But it happened too late now. But nothing is never too late to start investing, especially youngsters who are watching this program. Start investing, and if you are real estate, it's quite risky because you don't know whose land you are buying. Tomorrow they'll find this land doesn't belong to the seller who sold it to you. I keep seeing them in the newspaper. Thanks so much, Babu, Satya and Ajit for fascinating evening. And I request Mr. Sundaram as well as Venkat joining me on the stage. We'll present a memento to the panel.
You asked a question, please come. That's okay. We will consider the comment as question.
Come.
Yeah, see?
Good, no? Come. All of them. Thank you, ladies and gentlemen. Goodbye till we meet again. Good night. See you.